Hey everyone, we are live. Thank you so much for joining me. I'm Mitch Goldberg. I'm a financial advisor with 30 years of experience. I am with a firm called Client First Strategy, in case you missed the branding all over. It is a pleasure to have you with me, and we have a lot to cover. It was a tough day today, another give back day after a couple of nice days last week. Last week was a big week. It was one of the biggest weeks, I think, the biggest week since the 1970s. So it's natural to give back a little bit, but this is why I always say, I don't like these big up days and big down days. I would rather things take a little bit longer. But in the hyper-connected, hyper-flow or hyper-velocity of information, things move so damn fast that you have major economic events and market moves that get factored into stocks in a matter of a day or two that used to take a couple of months. So, we have to just put up with it. It's part of the process, and we're not going back, folks. We're not going back to a slower level of information dissemination. So this is where we are, and we are going to talk about a couple of things in particular. It looks like a few more firms have jumped on to the market has already bottomed narrative. What else do we have? IRA distributions, a few things to talk, IRA contributions, rather, a few things to talk about that. And also, is it possible to have a rapid return to economic normalcy? So let's take a look at these important factors. I'm going to go through the big stories of the day that affect you, your money. That's what the show is about, to make you your best possible version of your financial self. So without further ado, let's roll the intro, and we're going to talk about a couple of things. Okay, good to have you back. So here are the rules. What I'm going to do is go through the couple of key points here. Then I want to take a quick break to give the shout outs, welcome people to the show. I know you're out there, and I that's my favorite part of the shout outs, welcoming you and answering your questions in the comments, just addressing your comments. So I will get to that as well, but I don't want to interrupt the flow, the flow, Joe, here. Okay. Flow. I don't want to interrupt the flow. Okay. So to start, welcome to another episode of Be the Boss of Your Money. It's about making you the money boss. I mean, who's in charge of your money? Is it you, or is your money in charge of you? So are you in charge of your money, or is your money in charge of you? Money is a funny thing. It's actually difficult to control money sometimes, because there are so many things outside of our own control. So that's what the show is about taking control, increasing your understanding, your education of markets. So first thing off the bat, let's take a look at some winners and losers. We'll do a quick share screen here. Okay. And then we'll see who the big winners were. Okay. The only winning sector today, I'm going by a list of the Spiders ETFs. XLK was up barely, just up a drop. And that was followed by consumer discretionary and energy. So those are the top performers. And at the bottom was real estate, financials, and utilities. Okay. So I have my own preference of which sectors that I would like to see lead the market higher. I would rather financials be a leader, not a laggard, because when financials are doing well, that usually means everything else is doing well. But when financials are doing poorly, it means everything else is doing poorly too. So that is one thing that I want to address. The other thing is this. I think one of the most significant pieces of news is something that I read over the weekend. I'm sure you saw this also. By the way, great article on the homepage of CNBC. Here is everything that the Fed has done. But I'm going to stop sharing the screen. Like, you can see the Dow down 328, NASDAQ up a drop, which is why the tech sector was up today. S&P off about 1%. Okay. By the way, when I say S&P 500 or Dow Jones or Nasdaq Composite, these are indices. You cannot invest directly into an index, but you could invest in a security that mimics a traction index. The most significant news that I saw over the weekend, and it's really coming out a lot more today in more broadly distributed news, that banks are tightening up their lending standards for mortgage borrowers. Now banks want to see 20% down. I know a lot of you thought it was always like that, but it hasn't been like that for a while. And they want to see higher credit scores. This is very reminiscent of what happened during the Great Recession from '07 to '09. And what happened then is that credit became difficult to come by. Lending firms, for mortgages, for consumer debt, auto loans, et cetera, it became very hard to get a loan unless you were like a pristine credit, pristine credit report, and you had big down payments. And that really hurt the economy even more. And because of the tightening in lending standards, it dragged out the recession and bad news for a lot longer. Now, the Fed is trying to do everything. The Federal Reserve, our central bank, is trying to stop that from happening. They can't tell banks really to not be strict. Banks are allowed to be as strict as they want. The banks can't be less strict than what Federal Reserve guidelines dictate, but they could be more strict if they want. Okay, the Fed cannot force a bank to make a loan, for a mortgage. But having said that, the central bank, the Federal Reserve, are buying mortgage-backed securities, and what that means is when you go out and get a mortgage, your mortgage is put together into a pool or a portfolio of similar mortgages from other people, and they're put into a security called a mortgage-backed security, a bond, and then the bond is sold to the investing public. But if the investing public won't buy, institutional investors won't buy these, then the Fed said they'll step up and they'll buy it to keep the mortgage market flowing. I don't know if it's going to help. I mean, yes, anything will help. But if the banks are tightening standards, then that means fewer people would even be able to get a mortgage, which could hurt home prices, valuations. It means you people would have lower equity possibly in their house. So that's why this is such an issue. It bears watching. I'm not saying it's a disaster, but if more and more banks follow that, then it's going to be a spillover into the real economy in terms of the real estate, in terms of residential real estate. Let's talk about the narrative about Goldman Sachs and JP Morgan. And I thought this was significant. I made a call on March 23rd, was a Monday. That was so far the bottom of this bear market. The week before, I said heading into that, so let's say the 16th, 17th, I said, I gave the worst case scenario in terms of what could happen with coronavirus, the economy, et cetera, death. It was a very gloomy assessment. I said, this is a worst case. I didn't say it's the most likely case, but once you understand what a worst case scenario is and you don't get it, I think it helps put things in perspective. You can always say, as my mother would say, things could always be worse. Sometimes things are worse, but in this case, one of the reasons why the stock market has rallied is because things haven't reached their worst case scenario that investors envisioned. And even you saw today, Governor Cuomo in his announcement said, things are starting to ease up a little bit. We still have to be careful. We've got to be smart about it, about lightening up and getting non-essential businesses up and running. But we don't want to do it too fast because we don't want some crazy coronavirus rebound. But we can't stay in the economic environment we're in forever either. Now, the Federal Reserve, the government, the stimulus acts, the CARES Act, a lot of businesses are going to get a lot of money pretty quickly that will help for a few, maybe 2 months. But the problem is if this recession we're in and this mandated shutdown we're in goes on for more than another 2 months, when the stimulus gets used up, then what are we going to do? So that's why we really need to see, that's why everybody's putting pressure on themselves, if you want to know, to get the economy back up and running as far as politicians go, because could we really afford to do a whole other round of, monetary and fiscal stimulus? The monetary and fiscal stimulus that's come out over the last month actually equates to about half of U.S. annual GDP and is way more than what was done during the entirety of the Great Recession. Okay, so anyway, I made this call saying that, I had that gloomy discussion, because people were like texting me, you're making my blood pressure go up and things like that. And I didn't mean to do that. I just wanted to give the worst case scenario again. Okay. So what happened after that is I said in that same call, that same live stream, that I actually am a buyer now. As gloomy as I gave it a worst case scenario, I said I'm a buyer. By the time I got to the following Monday, that was the bottom. We came back strong the next day because of a lot of stimulus was thrown at the economy. And I said, listen, if the Fed is going to, and the government is going to support the economy and replace the private sector, and things don't turn out as bad with coronavirus, infections, ICU admissions, et cetera. I'm trying to choose my words carefully because I don't want to come off like I'm insensitive to what's taking place, but this is a show about money. Then we probably saw the low. I said that the 24th. The low is the 23rd. I said, we probably have seen the low. Now, I could be wrong, and I'm the first person to say we didn't see a low. We have hit a new low. But the further we get from that low, the more comfortable I feel with believing that. It doesn't change the way I'm going to invest for my clients, by the way. We're long-term investors. It doesn't mean I'm timing the market and whipsawing their accounts into cash and stock. We still invest the same way. But you do want some kind of frame for mind reference, okay? And we've been on a pretty good tear ever since then. And now you've seen even more stimulus come out from the government. The CARES Act, the Federal Reserve did another $2 trillion plus kitchen sink stimulus last week. So we have more and more coming out. You've seen horrible employment numbers. Something like 10% of Americans have lost their job already. And that's expected to go up to 15 to 20%. But as you see, some things didn't turn out as badly as expected. And with all the stimulus, stocks are holding up okay. And now Goldman Sachs was basically saying we've probably haven't seen the low yet of this market. But now they came out today and said, stock market, I'll show you the headline because you're not looking at the same thing I'm looking at. I love this share screen ability. Okay. So here you see the headline. Okay. Goldman says market is unlikely to make new lows because government is doing whatever it takes. Now that's annoying to a lot of people because a lot of people, a person of sane mind would say stocks are going to crater even more. We're going into a depression. There's no money going around, tons of business failures. It's awful out there. But what's been going on for the last 10 years, every time someone has a bear market call, government stimulus comes in and destroys price discovery. Price discovery would say things are getting worse, stock market should go down. But stimulus says stocks should go up. So you might not like it, but that's the story of the day. And then JP Morgan's Kalanovic, he's their quant guru. He comes out and says, he says he called the turn. First over here, he sees full asset price recovery by the first half of 2021. That means he expects to see new highs within a year and 2 months. I could live with that. Can you? Yeah, I could live with that. Not to say it's going to be all smooth sailing. We've got a couple of comments. So now I'm going to just take a look at the comments out there. Hey, Filippo, good to see you out there. Yes, see you later. I'm glad you're here. Hey, Bill. Hey, Mitch, keep it up. I think I could show these. So we've got one from Filippo. From Bill. Bill, thank you so much. Hey, man, sorry I'm late. Love the videos. You know what, Filippo? We're just getting started. And anytime you show up is a good time. I'm here every day, 4:30 p.m. If you're a little bit late, don't worry about it. We'll keep the show going. Scott Rosenberg. Scott, I love your dog. You have a really cute dog, by the way. Thank you, buddy. I really appreciate you being out there. And Filippo, Mitch, what are you doing in front of the stock exchange? Get home now. The weather in Manhattan is improving a little bit, so I took my rain jacket off, and I decided I'd stand out here in front of the New York Stock Exchange. Thank you. You like the green screen effect? It's hey, nothing shouts financial advisor more than, the New York Stock Exchange behind you. So I really love my green screen effect. So that's what's happening. So is it the economy or is it the stimulus? Economy versus stimulus, which one's going to win? Right now, the stimulus looks like it's going to win. If coronavirus admissions to hospitals in New York keep going down, fewer reported deaths from the virus, fewer people on ventilators, then you have a durable recovery, and investors start to factor in getting back to business. So when you get back to business, no one's saying anything about pulling all the stimulus away. So if we get back to business, granted it won't be the business we were in a month and a half ago, but getting back to business with all of this stimulus, trillions and trillions and trillions, that is a powerful combo for paper assets for the stock market. Okay, so don't get too bearish. This is why I don't like market timers, who are all in or all out. Now, I've been doing something that I've been talking to you about called upgrade and the downgrade. And thank you for the smiley faces and the hearts out there and the thumbs up. Thank you very much. And by the way, your words of wisdom, certainly share them with us. I would love to see your words of wisdom as well. If you have any questions, go ahead and ask away. If you're watching in LinkedIn, thank you to you as well. And YouTube, thank you. And of course, Facebook. So if you have any words of wisdom, please let me know. I want to hear all about it. And, words of encouragement are always appreciated too. So I've been saying upgrade on the downgrade. And that means when you have a bear market and a recession, that's when you find out which companies are really financially strong, which ones aren't, and you have an opportunity to get rid of the weaker players and upgrade to the strong players. And it's a good time to do it, I think, when everything is down, because you're not taking your money out of the market. You're just replacing your investments to potentially a better one, hopefully a better one, right? And plus you get to claim the tax losses on the way. So I don't think it's too late to do that. Okay, I don't give tax advice, by the way. I'm not a CPA or a licensed tax advisor, so you have to check with your own tax advisor. Just want to get that disclaimer out there. But if you are someone who said, darn it, I wish I wasn't so heavily into the stock market, I really regret it, this is too much for me. Right now, the markets, believe it or not, are not really down that much this year. Okay, maybe 14%, 15% tops. After the year we had in 2019, it's not the worst thing to give a little bit back. So if you're of the mindset that you are over your skis in terms of risk, right about now could be a good time for you to reassess, reevaluate, and maybe make some changes at this time. Okay. You got past the bottom, that, oh my God moment when the world is literally falling apart in the major averages, the oil price war between the Saudis and Russia. A lot has gone on. I mean, in the last month and a half, it's amazing. It's like we've had like 3 years worth of crazy news compressed into such a short amount of time. I'm not even getting into the coronavirus news. That's a whole other piece of news right there. So that's what I am suggesting. It's also a good time to, if you haven't yet, rebalanced. Now, I mentioned that I was rebalancing accounts a few weeks ago, and I might even rebalance again for some accounts, because it's just the moves have changed so drastically. The markets, the levels have changed so drastically. So last thing is this, if you are making an IRA contribution, I've been getting asked this quite a bit. Your IRA contribution normally is due when you file your taxes, or April 15th. All right. This year it's July 15th. So if you haven't made your IRA contribution yet, you're gearing up to it, you do have until July 15th. Now, if you think the market's down enough and you want to make your IRA contribution now, go right ahead. But I'm just letting you know that just like the tax filing deadline has been extended, so has the IRA contribution deadline. So I just wanted to get that out there. Let me take a quick peek out there. Okay. So we'll have everybody out there, because I'm getting ready to wrap up this call. Okay. So we've got a few people out there. We've got a couple of viewers out there in LinkedIn land. Hi, Tori. Nice to see you, and thank you so much for the good wishes. Yes, we are all happy and healthy and safe in my household. Thank goodness, knock on wood. There are a number of households in my neighborhood who we know that are not so happy and healthy, and we pray for them. Whatever, I put out a few messages and texts and calls. If you need anything, let me know. But we've heard some pretty bad stories, and I'm sure it's the same wherever you are. Okay. So other than that, we have, hey, Robert Tolan. So now I'm going to do my shout outs. Hey, Robert Tolan, thank you so much. Steve Schultze, great to see you, buddy. Thank you so much. Maddie, you were always so supportive. Means a lot to me. Thank you, Maddie. And Andrew Janisic. Andrew has just helped some not-for-profits find PPE and masks and gowns and all that stuff. So he is out there doing a great job, and it's amazing how they've been able to pivot over there. So while we say pivot, I want to try something that I've never done before. Okay, so I'm going to try something while we're talking about the word pivot. Okay, let's see how this goes. Did you see that? Oh man, I'm trying all kinds of new things. I've got one that's a little bit on the immature side, but I got to roll with it. That's what she said. Oh man, that was so immature. Okay, so I'm having fun with my my live streaming. So thank you all who are out there, and Eric Friedman, thank you. Love your dogs, by the way, and good to see you out there. Thank you so much for your support. We got to you, Scott Rosenberg and Filippo and everybody else who left a comment, and everybody out there. I've lost my Wi-Fi in my house, and I'm wondering if we're going to lose all of our internet connections and electricity because the weather is freaking horrendous right now. All right. So I'm going to call it a day. I'd like to wish you well. If you have any questions that you think of after the stream, hit me up in the comments. I'll be checking for those. And I hope this helps you be the boss of your money. I'll speak with you soon. Thank you.